G'day, ladies and gentlemen. Thanks for tuning in to another episode of Investor Types. We're talking about investing into Australian stocks, but the mid to large cap names. So think about the names you see every day, the big companies you use, the names you see advertised on TV or on the side of a building. We're talking to a bloke by the name of Matt Williams, who runs a fund called Airlie Funds Management. He's been investing into Australian stocks for 24 years and has built up a whole lot of experience over time. We're going to deep dive into what's happened during coronavirus. We're going to look at some specific names. Matt's going to impart some knowledge on us and talk about some companies he loved to own at the end of coronavirus and some industries he'd love to be involved in. Not only that, we're going to talk about if you're going to invest into these Australian stocks and go hard and build a portfolio, what are some things you have to keep in mind? How do you value companies and how long do you need to focus on investing for? Now, before we get into the episode, I just want to remind you that all the information here is just general information only. Please don't consider it as personal advice. And if you want to build a stock portfolio for yourself, go and consult your own financial advisor. In saying that, it's a great episode with some really insightful knowledge. So tune in, sit down, reach out to me with any questions. Let's get into it. G'day everyone. Welcome to another episode of Investor Types. What we're talking about today is we're going to deep dive into investing into Australian equities, but more or less buying into the names of companies you love. And we're lucky enough to be sitting down with Matty Williams, a 24-year veteran into investing into Aussie equities. Matt, thanks for coming on, mate.
Thanks, Stefan.
Matt, could you tell us a bit about your journey in investing into Australian equities and your experiences?
Yeah, so I started in the early 90s, basically fell into the industry and realised I absolutely loved it. Loved the variety, loved looking at companies and using your brain, and it's a real mental challenge and an intellectual challenge. And there's a bit of science obviously involved in investing, but you can't beat a good bit of art and psychology that is thrown in there So it's a fascinating industry, and I've been very lucky, very privileged, I think, to be part of it over the last 24 years.
Good. Now you're running a portfolio, Airlie Funds Management, focusing mainly on investing into mid to large cap companies. It's more or less the names that a lot of Australian people know within Australia. Would you say that?
Yeah, generally. So it's the Airlie Australian Share Fund that myself and co-manager Emma Fisher are running here at Airlie. And it's look, we're pretty conservative, and this is a real kind of core fund. It's a fund that's not going to blow the lights out in terms of taking big bets that may or may not work. It's basically a core fund. It's a great fund for having for the long term, for savings, and we're just going to try and own the best businesses in Australia at any given point. And it's quite a concentrated fund. We're going to have it with 25 stocks. We're going to be mostly fully invested. We're not going to try and time the market so much. Our cash limit is about 10%. So we just want to own good stocks and own them for the medium to long term.
They say, I was reading something the other day, they say those who have tried to time the market have normally lost. And that's why many people don't try and time the market anymore. It's just all that once you focus on long term, you generally become a winner.
Generally, that's right. And I think some people are good at it. But I think the Australian market is such that I think on a global basis, it's a much easier kind of thing to time. But Australia, I think, is a bit different. So we prefer to take that off the table and own good companies. And we've all seen those stats, all right? About if you've missed the 20 best days or the 30 best days in the market over a period of 5 years, you've missed a lot of the return. And I find those stats fascinating because it just shows you just how hard it is to try and jump in and out of the market with the whims of sentiment.
100%. So let's look at some of the volatility that happens in markets, and more or less, so we're filming this in July 2020, and there was the D-Day of COVID really hit on the 23rd of March 2020 when the ASX 200 was at 4,500 points, fell from a top of around about 7,100. Now, for those of you who don't know out there, the ASX 200, that's essentially the Australian index or a measurement of Australia's largest 200 companies. And it sort of gives an indication as to where the Australian market's at from a stocks perspective. Now, since that 36% drop, it's risen to approximately 6,000 points, which is a rise of 32%. We'll look at some individual companies because I know you like to buy individual companies. Let's look at one of Australia's market darlings, CSL. Went from a top of 341 down to 282, dropped 17%. 4 months later, hasn't changed. Still at 282, hasn't risen a dollar. Look at NAB. NAB dropped from $27 all the way down to nearly just below $14, dropped 48%. Since then, has risen to about $18, $19, risen about 34%. We'll go even further. So we'll look at a mining company. So BHP, which a lot of people know, went from 41 down to 25. So dropped about 15%. And then it's risen to 38. So risen, that's a 52% climb. Macquarie Group really got smashed during this period, dropped from 151 to 72. It's a drop of 52%. Then in the next 4 months, it's risen to 124. That's an increase of 72%. Now, these are massive levels of volatility. A lot of these companies, some are back to par or pre-COVID level. Others are close to, others are far off. But can you give us some insights from a professional's perspective? What's been happening to the Australian market during COVID?
Yeah, look, it's been, in my 24 years, it's been I haven't seen anything like this. We've seen similar, down cycles and situations, but, this situation is worse than the GFC. And unfortunately, it's really touching on so many people, so many people's lives and businesses, unlike the GFC, where I think really it was a financial markets real issue mostly. Yep. This one is really much different and much tougher, and it's really hard for people in the market. I don't need to probably labour the point. There's been heaps written on everything that's gone on. It's been remarkable. The fastest bear market has given way to the quickest bull market, leaving us in a situation now where it's a very as you say. Well, here we are back at some of these stocks at par. But you'd have to look out at the operating environment for a lot of these stocks and say, well, hang on, is the environment better or worse than pre-COVID? And clearly, the operating environment is worse. So it's quite a tricky period for an investor, and it also goes to show just how not doing anything can sometimes be the best strategy. And a lot of what we did in the fund was really during March 23, when the market hit the bottom. We were adding to our core positions we liked back then, and not doing much else really. And that's proven to be, I think, the correct strategy.
Yeah, I think I was reading something the other day that if you were to sell out close to the bottom or even halfway down, and you didn't buy back in, you lose so many of your losses for the next few years. And as to your stat before, if you're out for 20 of the up days in a year, you're probably going to make a loss. And that just holding true. Investing is an emotional game, especially when you start buying individual stocks. And that's why I've got a lot of clients who prefer to use a manager to invest their money, simply because that emotional roller coaster can magnify your losses.
Yeah, that is so true, Stefan. And after I've been through, the early 90s recession, the tech wreck of 2000, the GFC, and I guess, you'd hope I've learned something over that period. And what you learn to do is, separate your emotions and the sentiment that is out there. And, if you remember back to late March, the sentiment was pretty absolutely dire. But you've got to separate the sentiment from the numbers. Yep. And the numbers were very attractive and telling us, even though, we put some probabilities around just the likelihood of the length of the crisis. And even on some of the, more bearish scenarios, the numbers were quite attractive. And then obviously the central banks globally around the world stepped in at that point. And, that was really the sign that they weren't going to let this develop into a full-blown financial crisis. And so from then it's been a one-way rocket ship upwards.
Yeah, what history tells us is that after huge periods of government stimulus, or after big injections of government stimulus, markets rally, and markets rally hard. And we've never seen any sort of government stimulus like we're seeing right now for businesses, for individuals. So look, let's hopefully it gets back to where it was and the world returns to normal. But what's happening right now? So a lot of people jump on the bandwagons. They see a stock going up or they see something, the market going up, and they go, I need to get involved. FOMO, I don't want to miss out. I want to make sure I get involved. But where are you seeing valuations? And how important is it do you think, to value a business and buying at a good valuation as opposed to just buying in because it's going up?
Yeah, look, I think you're separating their speculation from investing, and speculation is fun. It can be fun, and particularly in markets where it just seems to be going one way, as it is now. But one of the great sayings about the market is that it's a great mechanism for transferring money from the impatient to the patient. And we like to try and be patient and buy things that we can value and can understand. But there's no doubt, given the outlook, valuations don't seem, we're struggling to find super attractive opportunities. I guess is what we're saying. The winners out of this crisis, coming, in the bull market out of the crisis, have been, obviously the tech names, particularly the buy now, pay later stocks, the staples, Coles, Woolworths, even Wesfarmers you'd throw in there, and then the mining companies. They've been the real winners so far coming out of the crisis. And I think the laggards, sort of the more economic sensitive companies, building materials, some retailers that really struggling, and obviously some consumer discretionary companies, travel companies. Those companies have been the losers.
So when we talk about post-COVID, do you think these companies that you've just spoken about, those consumer discretionaries, those building materials, do you think they'll recover as hard? Or do you feel that those businesses, the tech, the buy now, pay later schemes, those sorts of things, do you think they're the real winners over time?
Oh, look, it's hard to say. I think post-COVID, so let's say COVID is no longer an issue. There's a vaccine, or people feel that we're on top of it, and it's things open up fully. Then look, my number one stock for that period is Qantas. I think it's the most leveraged to a post-COVID environment where we all start traveling again. International travel opens up. People, they're desperate to go on an overseas holiday. So that's my number one sort of pick, and we hold that in the fund as sort of the, as a portfolio structure view, that we need something that if indeed tomorrow a vaccine looks more closer than it does right now, then that is the stock to own, and we're happy to own that. And they've raised money recently, so the balance sheet is looking good. It's just the length of time, I guess, between something happening and how long these companies have got to operate in a more tougher environment.
This is the thing, and investing into stocks, it's a waiting game. It's a long-term approach. Trying to get in and out really fast, it doesn't generally work for people. If you're going to take that approach, I tried to do it when I was younger. When I was in my late teens, thought I could be a day trader. I think ended up losing money and paying a heap of tax, which I didn't love. But then you look at, all right, well, how long do you normally hold a stock for? What's your view? So if you're buying, say, that Qantas that you spoke about, how long do you want to hold it for? Or any businesses in your portfolio?
Yeah, look, it depends on the stock itself, but there's been stocks I've owned in my portfolios over my career for 20 years. One in particular being Reece, the plumbing wholesale company. It was the first company I was given as a young analyst to look at, and so it's just held a special sort of place for me. And the fact that it's been an absolute, cracking investment over 25 years is obviously why it's still in the portfolio. And then there's companies like Nick Scali that IPO'd in 2003. I've owned for since that, almost off and on, but mostly on for that period. Mineral Resources, it IPO'd in 2006. It's been in my portfolios again off and on, but mostly on since then. Premier Investments. The Solomon Lew retail vehicle, that's been in the portfolio for 20 years. I'd probably hazard a guess.
Wow.
So,
Okay.
and it's interesting, like the common denominator amongst all those stocks is that they are, family run or founder run or founder owned.
Yep.
So that's interesting. I think, if you find a company that's run by someone who's got massive skin in the game, and when I say skin in the game, like own a lot of the company, and they take the right long-term decisions. You look at the Wilson family who've run Reece; they've just made winner after winner of decisions over the last 25 years.
Well, they still own
So
70% of the company.
they own about 68 at the moment.
68.
Yeah.
And they've recently launched into the States as well. So taking that plunge to, end of the day,
right.
if they make these investments to go offshore or to change the main structure of the business, they're risking their own money. And no one likes to lose their own money.
Yeah.
Yeah.
So those kind of stocks have been with me for a long time.
Mm-hmm.
But then there's others where, it depends on what the circumstances of your investment thesis is. They might be in for a year or something. It depends on how things go. Also, you make a decision. You buy a company. You've realised, hopefully you realise quickly if you've made a mistake, and you exit. I think that's a real skill of investing that has taken me a long time to get on top of. I'm still not on top of it really, but I'm better than I was. So that's how long you hold a stock for it really depends. But hopefully when you buy a stock, you're thinking at least a 2 to 3 year investment.
Yeah, and you look at CSL, which got listed at I think $4 in the early 90s, rose, and 4 or 5 years ago it was at 150, and you think, whoa, this thing has gone so fast. Do you sell? And if you don't need to sell and you believe in a company, why sell? And then it gets up to $280, and you're sitting there going, well, that was a roller coaster. This is exciting. And if you believe in something, you don't need to sell it. Then again, that's investing, holding on to something for the long term, hoping it really wins. When you invest in a stock though, so it's you can either do what your mates say, and you can follow what some experts say, but a lot of people like to go deeper. A lot of people talk about, what financials do you read? What do you really look into? I know you've got a 4-stage approach when it comes to picking certain companies that you love. So you like to focus on 4 things: financial strength, management, the business quality, and also the valuation. What makes you pick those 4 things when you're looking to buying a company?
Yeah, that's the process. We've looked at those 4 things since the early 90s when myself and colleague here, John Sevior, who founded Airlie, we started investing together. So look, we try and keep it simple, and those 4 things we found have kept us basically on the straight and narrow. It's really to help you when there's big fads in the market. Think back to the tech crisis, or think to all the leveraged businesses, the asset traders before the GFC. The Babcock and Browns and those kind of things. It's basically a process to keep us on the straight and narrow during times of extreme. And so it was not to blow up the portfolio at any point. So financial strength for us is a key. We just think that you can sleep at night no matter what happens. Mm-hmm. Look, the last 10 years since the GFC, financial strength in a company hasn't really mattered, but suddenly 3 months ago, it matters big time.
Yes.
And so it's those periods where that test really comes into the fore. The rest of the tests really what we're trying to do is find something unique in the business. Why do we own this? Why will this business succeed maybe in a competitive industry where others won't? And so we're basically looking for something unique. And an example would be Wesfarmers, who own Bunnings, right? And I think Bunnings is a very unique business. Mm-hmm. It's basically got that hardware market sewn up. It's a fantastic business. It's just so good. The returns on capital. I'm resisting the word dominant or monopoly, anything like that, but it's a strong business. Let's just say that. I think it's a very strong business. And then I look at something like a Mineral Resources, and people say, "Oh, mining services, terrible. It's been a graveyard for investors." But Mineral Resources has a unique mining services proposition, where it's much more a sustainable earning stream as opposed to the typical mining services company. Mm-hmm. So we're looking for something unique, within within these businesses that we can go, well, this is how value will be created over time, and that's what the other tests really are about. And sometimes the uniqueness is just a really good, strong management team. And I go back again to sort of Nick Scarley selling furniture. That is a competitive industry, if not one of the most competitive. But because of Anthony Scarley, the CEO, his unique style, he's growing up in the business. That is the unique proposition for that company, and it's been a fantastic investment for nearly 20 years. So that's what we're looking for. We're trying to identify that uniqueness in a company.
One thing that's so important, as you just said, the management. It's so hard for an individual like myself to assess the management, and when you don't sit down with them, look them in the eye, but understand their background as well. And even when it comes to board levels, the clash of personalities. I've seen some businesses who have merged into other companies and then tried to onboard their board members, and they don't get along with the existing board members, and things can really fall apart. So I think it's a crucial part of investing, understand how a business is run, who runs it. But I want to move on to something else, something I get asked all the time. All right. There's two main pillars when it comes to investing into Australian stocks. People invest for dividends. Some people invest for growth. Dividends versus growth. What do you prefer?
Yeah, so look, in a 25 stock portfolio that we run, and in Australia where, unfortunately there's not the choice of growth that you can get, particularly say in the US market. So it's got to be a mix of both. You've got mature companies that you want to just pay out the cash and pay a good dividend, a good franked dividend, and that's all you want them to do, really. Yep. I think so many Australian companies have blown themselves up by not being satisfied with that sort of mission. It's not exciting enough for them, and so they go and do these big projects, go and acquire offshore or something, and they don't have the skill to do that. Yeah. But look, if you had a choice between, and this, and the example is you've used CSL. CSL back at $120 at the time, the forward dividend yield was around high ones, maybe 2%, versus Telstra at the time, where the dividend yield was 6%.
Yep.
Now, I don't know about you, but give me CSL at $120 yielding low versus Telstra yielding high. I'll take CSL any day of the week. So I think that's that's where my foot is in, definitely in that camp.
Because the dividend yield stays the same, and the share price doubles, essentially you're getting double the amount of dividend that you were getting when you bought it.
That's right. You're looking for dividend growth. That's what you'd really like is growth.
Yeah.
Dividend growth and sustain. If it's there's something behind it. It's not just a flash in the pan or a cyclical uplift, but there's something behind it. Yeah, you take that investment any day of the week over just a steady run-of-the-mill dividend payer.
I like that. So don't look at something that's paying the big percentage just because it's flashing lights. Typically, they're not reinvesting back into the company well enough. If you can find something that's paying a decent dividend with good growth potential, your dividend's going to grow with the company and your underlying wealth's going to grow as well. Look, perfect. So, Matty, it's been a really interesting conversation. The main point of this conversation is to help people understand, well, if they wanted to jump into Australian stocks or Australian investments, let's say you've got someone who's a property investor or a property lover out there and they go, I want to start investing into Aussie stocks. Can you tell me what would be their personality type? What would you say to them? What advice would you give them?
Well, it's interesting time in the market right now because there's so many speculators. We've seen all the the Robin Hood traders in the US and the lucky people who have invested in Afterpay just in the last few months, at the low and have risen it all, rode it all the way up to $70. And so people feel, there's the FOMO aspect and go, I should be getting a piece of that. And look, that is fun. Speculation is fun and people learn their lessons. But I'll go back to the point that, actually investing is a bit boring, really, because once you find something and you own it, sitting on your hands can be quite dull. But it takes discipline. You've got to be able to do that. And again, I go to my great saying, which I love, is that over time, the stock market is a mechanism for transferring wealth from impatient people to patient people.
Mm-hmm.
And so when all these day traders and speculators, get washed out of the market, which usually happens in a cycle,
mm-hmm.
then that money goes to the patient investors, and then speculators kick the can and they go, this is stupid. That market, the markets are, ridiculous, and I've lost my money. But really, the market is not about that. It's about investing for the medium and longer term, which is actually sometimes pretty boring.
Yeah. Well, you look at a lot of the people that have made their wealth around the world, around Australia, it's the people that have been willing to take their time to say, look, it's a long-term approach. Happy to sit here, happy to just let the market do what it's got to do. I couldn't agree with you anymore, Matt. So in saying that, look, I want to say thank you for imparting some of your knowledge on me and on the people watching. Been really insightful. Thank you so much. So ladies and gentlemen, if you're thinking about investing into names you love, into names you really know, this is partly the conversation for you. Matt, 24 years of experience, mate. Thanks for taking the time today. I really appreciate it.
Thanks, Stefan.
Now, for those of you out there, if you've got any questions, feel free to comment on the video. Otherwise, feel free to reach out to me, investortypes@gmail.com, and I'll get back to you when we can. All right, Matt, take care, mate.
Thanks, mate.
Bye.